Hey guys, Silas here from Detrended. Welcome back to the channel. Boy, do we have a good one for you today. Let's get right into the charts and to the data. So we're looking at the SPY, the S&P 500 ETF. Why do we look at the S&P 500? Because very simply, it is one of the largest and most liquid markets in the world. And this is where the smart money and the institutional players are, exactly who we want to follow. As you can see here, we have a chart that is displaying seasonality. There's a phenomena called seasonality in the markets, and yes, it does exist. And so you can see we've got three different core data sets. We have a 10-year data set represented in blue, going back 2015 to 2025. We got a 20-year data set in yellow, going back 2005 to 2025. And then we have a 30-year data set in red, going back to 1993 to present. And then you'll see a green line here that looks a little weaker. That is today's current price action. So overall, this year has been a little bit weaker than it has on its normal seasonal basis. But the most important thing to look at and watch is up and to the right. We can clearly see that the market has made a tendency to find a bottom at this time of the year and then rise. So that means one thing: we are looking to go bullish. We are looking to be buyers of this market. And so we can also apply what's called detrended seasonality. This is where we take our data and we slice through all the years through what's called linear regression to smooth out the data, which gives us more defined buy and sell cycle highs and cycle lows. This is where we are. Therefore, this is an area on the chart that we are looking to buy, but we need to make sure it lines up with price through the lens of technical analysis. So just looking at raw data, that gives us an edge. We are looking to buy on weaker months with the expectation that prices have become exhausted and then prices will therefore rise. We can see the monthly average performance is weak, which it has been in February and up to this point in March. And then as we get into March, April, the spring, and into the summer months, we see bullish activity or buying by the smart money or institutional traders. How do we know that this is institutional activity? Well, one, institutional activity, smart money, i.e. hedge funds, pension funds, central banks, they're the ones that actually move price, not Johnny and Sally retail traders. But we can get a confirmation of smart money movement by going through what's called the Commitment of Traders report. This is the report, the COT report, that is published by the CFTC.gov or Commodity Futures Trading Commission every single week, which gives us an inside peek at what the smart money is actually doing and how they're positioning. As the markets got hammered in the first couple months of the year due to the new administration shaking things up, largely a lot of tariff talk and uncertainty, that spooked and rattled the markets, which is perfect as it's now lining up into the ideal buying situation. Now, as we go back to the Commitment of Traders data through our COT Insider software, we can see going back approximately 1 month or the last 4 weeks of data, smart money has positioned themselves from net short to now net long. A little under a month ago, smart money was short 35,300 contracts. Then in a 1 week period, they went from 35,000 contracts net short to 30,000 contracts net long. Then in another 1 week period, they basically more than doubled their position, going from 30,000 contracts net long to 76,000 contracts net long. This is all occurring on the heels of open interest climbing. And so now we're having all of the stars starting to line up. We know we are in one of the most bullish times or bullish windows of the year for the S&P 500 and indices in general. We've got end of quarter rebalancing. We've got last minute retirement contributions. We've got rebalancing. There's a lot of behind the scene forces at work. And for those that don't have this data and this information, simply do not know and therefore do not have an edge. Remember, the main players in the markets are smart money, i.e. hedge funds, pension funds, central banks, what we call non-commercials. You have commercials, which are the hedgers, the producers, the processors, and then you have retail traders, or what we call the dumb money. So we can see the non-commercials, which is the smart money. We see this ticking up, meaning we see buying coming in. We see open interest in purple also ticking up. This means more and more positions are being added to the open market. And of course, we know we are now into the time of year that kicks off the most bullish time of the calendar year for the indices. Let's lastly go do some quick technical analysis to ensure that we are always buying at fair value, meaning we like to buy low, sell high, not buy high, sell low. So if we look at where we are in price, let's do a couple of things here. We're going to map out our chart and our price using some basic zone analysis. You can see prices have come down to an area where price has clearly bounced. Remember, old resistance usually acts as support. We've come through there, we bounced off, and now we're expecting markets to go higher. We also can get further confirmation through what's called Fibonacci. We're going to take this swing low from here in August, going up to the recent all-time high plotted in mid-February. Price has made a beautiful 618 retracement right here, and our targets to the upside are going to be back to these all-time highs at around 608. This is the core analysis that we execute on, the methodology we work inside of Trades Trading. If you like this video, make sure to subscribe, hit that like button, and we'll see you on the next update.